How can you pay less tax in your retirement years? Hey guys, I'm Justin Holtz. I run a team of 3 that's focused on pre-retirement planning for people in their 40s and 50s, and we answer questions like this almost every day. So let's dig right into it. How can we create a tax-efficient retirement withdrawal plan? Meaning, how can we pay less tax in retirement? Look, this topic gets a lot more interesting when we talk about saving money, right? Money becomes a lot more interesting when it relates to your situation. So how do we set ourselves up in retirement to save money on taxes? Well, it starts well in advance of retirement, 10, 20 years out. You want to be funding different types of accounts. Each different type of account, traditional, Roth, or taxable accounts, carry different tax rules. And so that allows us to create an efficient plan to optimize that later in retirement so that you can pay less tax. And it all it's based on your tax rates, what your income's gonna be, what level of assets you have. So each situation is unique, but it starts by funding these accounts in advance. So what we wanna do is we wanna fund your traditional, whether it's an IRA or an employer-sponsored plan. We want to fund a Roth, same thing, whether it's an IRA or part of your employer-sponsored plan. And we want to fund a taxable investment account. These are one of your pay-as-you-go type of accounts where qualified dividends and capital gains can be taxed at lower rates than what you might pay on ordinary income. Now, of course, the traditional type of account is tax-deferred. It grows tax-deferred until you take money out in retirement. Then it's fully taxable as retirement income. And the Roth money is after tax. And when it comes out, it's tax-free if the withdrawals are qualified. So based on those different rules, that gives you an opportunity to fund 3 different buckets. And then you have choice later on down the road on how to pull money out. So you might be saying, that's great, but how much should we fund each account with prior to retirement? I wish I could give you an answer, but the situation for each one of us is unique. It's gonna be different for me how much I should focus on Roth versus traditional versus taxable accounts than it is for you, than it is for your neighbor. But we do wanna fund each one of those buckets to some degree with significant contributions. So we have significant account balances in each one of those 3 accounts. Now, how much you value tax deductions now versus after-tax money in the future, some of this is personal preference, and some of it's based on how much money you're making right now versus how much money we project to make in the future. All right, so you might be asking, why is this important to fund these 3 different types of accounts? How does it really play into what could be a problem in the future? If you just fund, and this has been the traditional history of this, just funding a traditional IRA, a traditional employer-sponsored plan, 401k, TSP, if you just focus on that as your sole retirement, you're creating a bit of a tax bomb. So this money grows tax deferred, which is wonderful. You get tax deductions up front, saves you a little bit of money in the current year. But then when you get to retirement, all this money comes out as ordinary income, depending on what your other income sources are: Social Security, pension, other investment income. This IRA money is going to stack directly on top of that and increase what your marginal tax bracket might be. Now you might be thinking, well, if I don't need to take money out of this IRA account or employer-sponsored plan, it's not going to hurt me, right? Like, so that the income doesn't come out, I can just keep it deferred. But that's the catch, right? You're required to take distributions when you get into your 70s. This number starts at around 3.5% and goes up as your age increases over time. It's based on a lifetime, your life expectancy, essentially, a uniform table of life expectancy. So it starts at 3.5%. When you get into your 80s, it increases significantly, up over 6-7%. So if you have a significant balance in an IRA account, let's say you have $1 million, $2 million, 5% coming out of that can increase your tax bracket significantly, right? And push you into much higher and really create that tax bomb. So that's what we want to avoid. So let's talk traditional approach to pulling money out of accounts versus something a little more balanced, a little more proportional. Now, the traditional approach has always been take the taxable money first, take the traditional money second, and take the Roth or after-tax money last. Okay. Now, this plays into exactly what we're talking about with those IRA account balances growing and RMDs increasing. So that's how it can increase your tax liability over time significantly. In contrast to that, a proportional strategy proposes that you take balanced amounts from each one of the 3 buckets when you start retirement. This way, you get some of that RMD money out. You can also be creative with this. You can create a Roth conversion strategy in the early years as well. If your income's low enough, you can essentially fill up tax brackets to a certain degree. You don't want to go over if you're in the 22% or 24% tax bracket, you don't want to go above that, push yourself up into a 30% tax bracket by doing Roth conversions, because you want to be smart about filling tax brackets and getting some of that IRA money converted, some of the tax taken care of while you're in a lower tax bracket. All right, so let's recap. I know this is exciting material, especially when we're saving money on taxes. To recap, we want to create different types of accounts. We want a traditional, a Roth, as well as a taxable account to fund over time to give us the opportunity to take a balanced withdrawal strategy when we get to retirement. That's the key. The taxable account, in my opinion, is my favorite. It's the cornerstone that's going to allow you flexibility and choice. Okay, so that's kind of the key, is funding those accounts and then looking at your unique situation, looking at those numbers and seeing exactly what makes sense from a withdrawal standpoint when we get there, how much we should pull from each bucket to get you what you need, or just to reduce tax liability in the future. Even if you don't need some of that income right now, kind of getting money out of the IRA strategy can be a good thing. All right, so that's how you can create a tax efficient withdrawal strategy in retirement. So if you have questions, if you'd like to talk about your unique situation and how we might be able to optimize it to give yourself a better chance of paying less tax, I'd love to talk to you. If you're a do-it-yourselfer, I hope you find some of this information useful as you continue to build your own plan. Again, guys, Justin Holtz, I hope you have a wonderful day.